What up, young slumlords and ladies? This is Jake Lapp, and welcome to the Young Slumlords podcast, where me and Caleb Henshaw talk our shiz and hopefully help spark the idea for finding your financial independence in this paycheck-to-paycheck world. Welcome back, everybody. This week, we've got a really cool guest. I actually met Matt through a secondary relationship. It's actually the guy who does my cash value life insurance plan, which we're going to have him on the podcast at some point too, because I think that's really important for guys, especially at our age, going through all that, getting a really good long-term rate on life insurance and cash value life insurance that can be used as an asset. He was just like, oh yeah, like Jake, he does real estate. Matt, he does real estate. You guys should connect, and gave us a little introduction. And Matt had actually reached out to me, and we talked for an hour or so on the phone, and he told me his story and I told him mine, and we just meshed well. And he started listening to some of the podcasts, made sure that this is the type of stuff that he can get behind, and he's listened to a bunch of the episodes, and here he is. So with that, want to welcome Matt. What's going on, man?
Hey guys, thanks for having me. I'm excited to be here, and really appreciate what you guys are doing, sharing real great practical information. So I'm excited to be here.
Correct me if I'm wrong, but you said you've been in the real estate business for 21 years at this point?
Yeah, 21 years, man. I finished up college. I went to a school in Central PA, and then I had to go find myself. I traveled the country for 58 days. I moved out to Santa Barbara, California for a year. And then I called my best buddy up from first grade. He was back east, and I convinced him to quit his job, and we went the entrepreneurial route. We had a 6-month stint in day trading, which didn't work out well, but then we got our real estate license, and it was we started out four buddies living in Manayunk, renting for $1,000 a month at about 23, 24 years old, and then we said, guys, well, let's go buy a place, and we bought a place in Conshohocken, so did that for a couple years, and until we made a 2-year partnership because everybody was going on with their significant others after that. And so we did well on that one. And then Eric and I bought a property, gained a bunch of partners, and literally a whole bunch of partners. We created a limited partnership. The smallest partner was $500. The largest partner was $10,000-$15,000. And we purchased another property, single family detached home. And we learned a lot. We took that, we rented it out for many years, and then we learned about land subdivision. We partnered with the neighbor, turned 2 lots into 5 lots. So various different stories along the way.
Oh, wow. That's super interesting. I want to go back on a couple of things that you talked about. The first, what did you go to college for?
I went to be a history teacher.
Okay. Well,
and a history teacher and a coach. And although I never ended up teaching in the secondary ed in the classroom, I teach a lot of real estate, and I coached high school wrestling for 15 years.
Oh, awesome. So then, when you said that you and 4 buddies went in and bought a place because you were tired of renting, how did that actually work? Yeah, go ahead.
No, please go ahead.
No, so I'm just trying to think about it because, we've all sat in the basement in high school and we're like, man, renting stinks. We should all buy a place. And then that's kind of where that starts and ends, is more like that, oh yeah, we should. And then it's like, oh, you need lawyers involved. You need, all this stuff,
contracts and partnership splits and equity deals and all that kind of stuff. So yeah, how did you take it to the next level of actually signing it and buying a place with a group of friends?
Yeah, so it was about the time we first got our real estate license, and instead of in the basement, we sat on the roof of our place in Manayunk at 123 Green Lane, and it was 4 buddies talking about how we're going to figure it out. One of my buddies, very good buddies I grew up with, is an electrician, so very handy. And between the 3 others of us, we went and talked to a lender. We talked about what it would take to get involved with 4 of us, how we would apply for a loan. So, we started from the ground up. We went out and talked to everybody, learned about limited partnerships and what's involved with that. And again, our basis was 4 buddies who grew up together. So we were confident in the partnership, but we made a pact, to be honest with you, where we said, hey, if any of this goes south because of money, we're just going to call it a day and stay friends. And so we just went and met with everybody, and everybody gave us pieces of the answer. And collectively, 4 friends, we made it a goal. And within, I think it was within a year and a half of that mark, we ended up buying a place. I don't know how we got underwritten for a loan. We had very limited job history, but somehow it worked out. So the answer to the question is just, you get little bits of information from everybody.
Sure.
And you got to be willing to take the risk. I've learned about partnerships. They don't last. In this particular partnership, we gave ourselves a 2-year time limit so everybody could move on in life, and everything worked out on that one.
So what was your guys' goals going into that deal?
The goal of that one was very basic, that we were paying about $1,000, $1,100 a month in rent, and let's put this toward a house.
Okay.
And when we went to buy a house, let's say it was 2001, 2002, people felt it was too high in the market. Like, I can't believe you're buying that place for $110,000.
Yep.
And you can't do it. But what you learn and the path you guys are going is you do what you believe is right, not what others tell you is right. And nobody knew what we were doing. Nobody was like, all right, you just do this, this, and this. We were just committed. We have the entrepreneurial spirit. So we just figured it out.
How did it work with money? Like, I'm sure money was tight. Like, you guys were a bunch of broke college kids, like pulling money together, and then the disbursement. Like, the way that I'm thinking about it is, we buy this house, our mortgage is $1,000 a month. We all put this money down, we split it 4 ways, and then we live here together. Like, what was the end goal of that? Were you trying to flip it? Were you trying to keep it as a long-term rental? Did you have those goals?
No, we didn't really know where it would end up in 2 years. Once we were smart enough, or not smart enough, depending on how you look at it, to think ahead 2 years. But our goal was, we just kept track of the expenses, and it was just a limited mindset going, instead of paying someone else's mortgage, we want to pay down our own mortgage.
Sure.
So we didn't overthink it. We didn't know any more than that. And, in 2 years, we bought it for $110 and sold it for $167. So when you're in your early 20s, and, that was more than any of us had. When we started out, I think we all threw in like $2,500 each, and it was pretty much our savings for everybody, and we got it to work out.
So I'm assuming that you guys created an LLC.
We for that one, we might have been a limited partnership. It might have been an LLC.
Okay, so you guys are all equal shareholders of said partnership of the house. Now, when you go to actually make the payments and do, like, just the down payment part, like if everyone's putting $2,500, I thought on an LLC it has to be investment. Like, you can't buy a primary residence necessarily in an LLC, or did you guys?
No, the underwriting guidelines were different then.
Okay.
And we were able to buy a primary in the structure we had. But I can tell you that was before the Great Recession, and that was, the underwriting guidelines were definitely different. But when you were asking that question about the money, one interesting thing is, like I mentioned, one of the guys was very handy. And we had that discussion before we started the partnership, because we're like, hey, if we're going to live here for 2 years, what can we do to increase the value of this place? And he wanted to do work. So we were able to work it out where we all paid for the supplies, and he would increase his equity position by spending the hours doing the work. So we didn't have to pay him. So we got into details like that.
That's cool.
So was it actually like he was just getting a higher than everyone else return and still putting in the same amount of money, or was he trading, putting money in for that cut of equity?
Exactly. He was trading, putting money in. And that gets real tricky for anybody who does it out there, because I see in today's world where you have the money person and then you have the equity person, and somebody's on the beach this summer and they're working over the person who's sweating at the property. And it's a fine line. It took extra communication. There were bumps in the road, but 20 years later, we're all still best buddies. So
that's awesome.
It worked out for sure.
Would you recommend this to people in like the same age group, just starting out in college, 18, 19 years old, maybe 20, just renting in a college town? They got a couple grand saved up between everybody. Would you recommend them to do this exact same thing?
Oh, absolutely, because you are going to get so much experience that you're never going to get in the classroom. So if you go and you do it, maybe you do need mom and dad's help. That's cool, but the experience you're going to get get experience as a homeowner. You're going to get experience as a partnership. And a partnership, there's lots of ups and downs, and you need a lot of communication. So I would absolutely recommend it, so that you gain the experience, and now you're 22, 23, and you can decide, all right, I like the partnership, or hey, no, I didn't like the partnership, I'm going to go it alone, because I see what you guys are doing. I don't think it's too long before people are saying, hey, guys, we have some money. Are you willing to invest it? And you guys are going to have that opportunity coming up where it's going to be like, nah, we don't want to answer to anybody. We like doing our stuff ourselves. Or you're going to be like, man, we can get a 10 unit if we get 5 partners together.
Right. I was just having that conversation with Ben. So I want to keep going on like your chronological steps to where you're at now, but for everyone listening, I kind of want to skip ahead real quick to like where you're at now, what you're doing full time, like what you're holding, that kind of stuff.
Yeah, so right now I have a real estate brokerage in Conshohocken, a RE/MAX office with my best buddy who I grew up with. We started it from 1 agent. Now we're 39 agents. So that's our grind every day is, helping everybody out. We built it on a brokerage on one-on-one training and helping agents, whether they're investors or just helping people look for their primary. So that's what we're doing now. I've had 10 units, but right now I have 6 units.
Okay. So we were talking about it on the phone, but it seemed like on your team, you had a lot of guys who were like-minded, like how we are, how you are, like people that have had that spirit and have, started house hacking, have a couple multifamilies. Like what you were telling me, like you had a ton of guys on your team that were doing that. How did you like attract that group of people? I'm just curious. I feel like it's a very niche group. Like you go to most real estate teams and that is not the common thread.
No, it starts because my partner Eric and I started as investors.
Okay.
And so it's very easy to relate to that.
Sure.
And remember, from the realtor perspective, it's the long-term game. Is if generally the investments are less value, so you earn less commission.
Yep.
But it's about building the long-term relationship. And Eric and I just got used to knowing the investors. We do a good job for the investors, and then we started helping their family, friends. We do investments in primary residence and all that stuff. And then when new agents were coming in, they can clearly talk to Eric and I and recognize that, yeah, we have a background in investments. We know HUD homes. Mm-hmm. We know multi-units. We just know it from experience. And quite frankly, there's a lot of realtors who do amazing jobs, but they just don't have any interest in the investments.
Sure.
And so we're just able to relate to it. So for all the investors, and we have many in the office, and we're just able, no matter what they want to do, which avenue we have fix and flip, we have long-term rental people, we have land development people. So it just goes along the spectrum of different, what you can do with your real estate license.
That's awesome. And you guys also do property management, right?
We do property management. Yeah. Within that. Yeah.
So how has that been? Like, I feel like unless you really love the property management, I feel like that's something that a lot of investors want to step away from. You guys step towards it. Why?
Why? Because of the Great Recession.
Okay.
So to be honest with you, I never had any interest in doing property management. And then 2007-8 hit. And then what happened is by the time it was 2010 or 11, we were managing our properties. We had all the experience. We knew what we were doing, or we knew what we were learning throughout the process, making our own mistakes. And then all of a sudden people wanted to move on in 2011, 12, and 13, but yet they wanted to move in with a significant other, but yet they didn't have the equity in their home to sell it. So all of a sudden it was like, all right, well, I'll manage your property. Mm-hmm. All right, I'll manage your property. So it's just word of mouth, and that's how it grew.
No, that's awesome. So that's kind of a good picture of where you're at now. Take us from, 2 years later after me and my buddies bought this place, we sold it, we made a little profit. Like, what was your next step in life and then in investing?
Yeah, well, actually, I came across I was married once. It didn't work out in my mid-20s, mid-20s. And so after it was a twin that we sold. And the other half, I found out the gentleman next door wanted to sell it. So it was actually really interesting. I knew we were about to sell our house in the 160-ish range, and he wanted to sell next door for 120. So my then fiance and I bought next door at 120, knowing that we were going to be selling the next place. So bought that place. Yeah, so obviously we lived there for a year. Things didn't work out, and we moved on from that one. And then I bought a condo up in Lansdale in Chatham Village while I was just trying to get things worked out. And I hung on to that one and rented that out for many years. And then I bought a place, moved back to Conshohocken with one buddy, and lived there for 2 years. And we lived there we still own that place. And then him and I went on our separate ways. And then I bought a quadplex using FHA financing. The greatest investment I made probably 13-ish years ago, and was living in the one unit, and all the other units were we're paying for literally everything.
Yeah.
And great investment from that.
So I want to ask about that because we were recently looking at fourplexes in our area to do an FHA on, and as we're looking through these buildings and trying to imagine like an FHA inspection process for these places, it seemed like an absolute nightmare of just how many things would be on that checklist to get the approval for the loan. You're in the same area we are, a lot of old buildings here. Was that a similar scenario you ran into with a long checklist with a lot of back and forth?
Yeah, it was a long checklist even then, but we had a seller who wanted to sell and was willing to make up and take care of everything and get it all squared away.
What year was that?
It was 2007 or 8. 2007, because it was before everything went crazy.
Can we like dive into this particular deal, like what you bought it for, what it was renting? Do you remember that stuff? I'm sure it was a while ago.
Oh man, it was a while ago. Bought it, I think, if I remember, $365. And what were the rents? Gosh, one rent was 2 or 3 of them were rented in the 600 range, and maybe one was 700, and then the other one I moved into.
Okay, so you're buying for upper 300s, 365. You're bringing in, 2,000 a month roughly while you live there.
Yep.
That would be cutting it pretty close with your mortgage payment, right? Like, were you still paying something, or was it covering everything completely?
Yeah, it's been a long time, but it was just about. Well, I wasn't paying much to live there.
Right.
If anything, I wasn't making a killing or anything by living there, but it was 3.5% down off 365, and whatever the rates were then.
Did you end up refining out of that FHA loan?
No, I still have an FHA loan today. I think there was a. Oh man, I did something along the way. I'm blanking on the word, but got a lower rate. Got it to work out, and now it's very good cash flow.
I'm sure
great.
it is.
Yeah, because we were looking at on the deals that we analyzed with FHA on these quads. The
PMI was over $300 in that price range. That once you would refi, you could just get rid of that.
Yeah, delete it pretty much. Yeah. So
do you know what you're paying still on the PMI at that place?
It's gone because remember I passed the amount of years where you needed it, and the value went up. So the loan to value ratio covers it now.
Oh.
Because remember, I think in FHA, if I remember right, 78% loan to value. But it's locked in for a certain number of years. Again, I'm just talking off the top of my head.
Okay, yeah. I've been under the impression that it's like
forever.
The life of the loan.
Yeah.
The 30 years, you're paying that PMI. It doesn't go away. You don't. But I could be wrong as well. I'm not sure. But 78%, 100%, like I'm sure that building is worth a lot more than 365 now.
Yes.
Yeah.
Yes.
So no, that's awesome. So and in this, you bought the twin, you bought the condo, you bought this 4-unit. This is still while you and Eric are building your business and your team at the same time. This is what you're doing full time. Yeah.
So we're actually at that point we're realtors by day. We don't own an office yet, and we're working in a restaurant at night.
Okay.
Bartending, waiting tables, just making ends meet, and
yeah.
And we're regular realtors, and it was funny. We didn't intend to be full-time realtors. We only started out to be investors, and it was about 2 or 3 years in when Eric and I were like, wait a second, we can actually make more money being full-time realtors than doing a little bit of real estate and working at the restaurant.
Yeah.
So then we ended up being realtors for a number of years, and then about 2010, we took the jump to. We wanted to go down. Eric and I love teaching, coaching, and training. It's just a natural passion of ours. Mm-hmm. So we that's when we got into a brokerage, and again started with one. Now it's at 39, and a great group of people, and we're very fortunate.
Well, I mean, that's an amazing pipeline to get, A, new realtors on your team, and then also B, to educate people about their ability to buy houses at the same time and kind of just do both. So you can get people to join your team and then also sales for houses. So I think that's an amazing strategy for your business.
Oh, it was great. That reminds me of when Eric and I started, and we'd go out to the HUD homes and everything. But not only were we helping an investor, we were going to make a few dollars, and we were learning the market. It was amazing. So I'm out all Saturday, and if they didn't find anything they like, I just looked at 6 to 8 homes, so I know the market better. And it just you're getting a 2-for-1 every time you're out. Still to this day, we get it.
Yeah, absolutely. When you guys were at that age, mid-20s, early 20s, did you experience like a hard time as an investor? Did you feel that people looked at you with less
Like you weren't as well established as somebody who's been around for a while, so that you weren't like treated as seriously as someone, a lot of investors that we know are much older than we are, so it was kind of like a first impression issue.
Yeah. Oh, and I have a baby face, and I dealt with that all the time, and it was frustrating because here I am grinding it out, and nobody would help me. Nobody would take Eric and I seriously, and we were told to get out of real estate many times. And you went to school for X, Y, and Z, and you're not doing it. And there are many times, and we just, being an entrepreneur, you gotta stay with it, and you're gonna get a lot of people who we are very good friends with today said negative things back then, and it's just not knowing, and you just forge ahead and figure it out. But yeah, you deal with that all the time. Matter of fact, when it gets so, again, like I teach a lot of new real estate agents, and I get so frustrated when people have been in the business 27 years try to take advantage of the new realtor because they're new, age doesn't matter, and it gets so. I have that really bothers me. It's like, hey, someone here wants information, they're going to figure it out, and let's help them.
So now, going even before you guys started in real estate, do you think back on like something like what was it that kind of sparked that entrepreneur in you, like that made you want more than the 9 to 5 till you're 65? Like, what do you think back on, like what that was in your life?
Oh yeah, I know exactly what that was for me. So I grew up with a wrestling background, and wrestling is a sport where you're one-on-one on the mat. Your success or failure depends on yourself. You cannot blame anybody. You cannot blame a teammate. So I grew up with that mentality. When I was 18 years old, I was walking through the main building on my college campus, and there was a sign for start your own painting business. So my freshman summer, my buddies and I, we bought a painting franchise, and you had to figure it out. Your income was tied to as hard as you were willing to work, and anything you lost, you were responsible for it. So starting a painting business or buying a franchise at 18 years old kind of lit the fire.
That's so awesome. Like we had talked about that on the phone, but like that was almost identical to me. Like I started my own painting business when I was 19 in school, and like I think without doing that, I would be in a very different place. Like that transformed my outlook on working for the rest of my life, because you're going into business for yourself, and you're like, wow, like I'm making $100 an hour, $200 an hour by having all these other guys work and putting these systems in place and just grinding it out constantly and seeing the reward. Like the 9 to 5 doesn't appreciate that grind. It doesn't matter. You get paid a salary, you get paid your hourly amount, you work faster, you work slower. No one really cares. So if it's a good job, they'll appreciate it, and you'll get your bonus the next year or whatever it is. But
that hustle you're talking about, of that, is not for everybody, because there's a lot of risk involved with that. There's so much stress involved with that. There's so much uncertainty, fear, and doubt that you've got to go through every single day you're going through this. And it can take some years off your life, give you some gray hairs. Some days are much worse than others, but at the end of the day, once you build something and you can stop trading your time for money, it's just you break free.
Mm-hmm.
Yeah, I'll tell you. And the second painting job we were on, we actually got kicked off the site. So here we are, we bought a painting business. The second job we're on, a gentleman comes home. I know exactly where it was in Lansdowne. And what we were taught to do is to walk around the person around the house to show him the paint job. And after walking him around, it was 5:30, 6 o'clock at night. And it was actually kind of funny because his wife was home prior, and we're 18, 19 years old, and she offered us beers. So we took a beer at the end of the workday, and we're really excited. And he walks around the house, and he says, I'm giving you 5 minutes to get off my property and do not come back. So we literally got kicked off. And I tell you that story because we had to make some tough decisions after that. Like, man, we went down this path. We just got kicked in the teeth. And fortunately, we stuck with it. We worked it out, and we kept going. But being an entrepreneur, you get kicked in the teeth a lot.
Sure.
And that was an eye-opening moment where my buddies were sitting in the car talking like, hey, maybe we made the wrong decision this summer. Let's just go get regular jobs. And we stuck with it. But boy, we got kicked in the teeth early. Yeah.
So why did he kick you guys out? Like, was there a reason?
Oh, there was a reason, because we bought a painting franchise, but we didn't know how to paint. And the franchise we bought it from gave us a half day of training. So what I've learned is you do not paint a metal door in the middle of a summer day.
Yeah.
Vinyl windows we painted shut. Yes, vinyl windows we painted shut. You got to remember, we were entrepreneurs. We didn't know how to. I know how to paint well now,
Sure.
but we had no idea. I mean, literally, we painted vinyl windows shut.
Yeah, but that's so, like, I think that's such a good story. Like, when I started the painting business, I was going to school for painting. I was learning painting. Like, we made a ton of mistakes during the business. I would take on any job that anyone would throw at us. Is like, oh, do you do this? And it's like, yep. Like, the instinct is yes. But that just goes to show you guys knew nothing about painting, but started a painting business. Who cares?
Yes.
Like, anyone can do that, and that's the thing that I try to preach, because it's like, that's how I got my start, from painting at night and on the weekends was how I bought the first triplex. Like that, it was hand in hand. I wouldn't have the same savings rate if I was working a normal job making whatever, $20 an hour. It just doesn't work that way.
I think that kick in the teeth you're talking about is a vital part of any entrepreneur's like growth, and like you never forget that like experience, and it just either makes you stop in your tracks and then you give up forever, or it just like makes you think back, reflect on the mistakes you made, what mindset made you make those mistakes, and then grow as a person to be better. Because I still remember, I'm a tech guy. I've always been working in tech, and I had a side business doing it, and I remember my mistakes of irreversible problems that I had to just take, and like I'll never forget having somebody lose all their data for like 10 years on a hard drive. That was all my fault, and that look on their face never gonna go away, and like that just leads you to pay more attention to detail or whatever it is that help you grow.
Yeah, you're so right, and that's it's just a learning curve. Because you asked me that question earlier about someone who's 18, 19, or 20, should they try it out in that college town or wherever they're living? Absolutely. Because if you're going to get kicked in the teeth, I mean, matter of fact, get kicked young. When a new investor will come in the office, and whether it's me or somebody on the team who's trying to help them, and they're like, I want to flip properties, or they're starting, because everybody's starting, at different points. And someone will ask me, is like, how do you want that investor to do on their first investment? Do you want them to hit a home run, get killed, or break even? And the truth of the matter is, I want an investor to do break even or make a few dollars on the first one. Because if they go and they hit a home run, it's a false sense of security. They're going to go bigger the next time around, and they're probably going to get kicked in the teeth. And now they spent more money. And the truth is, if they bought a bad deal and they get crushed on the first one, they're probably going to never do it again. And it's just because it was wrong timing, wrong place, and all that stuff. So from an experience perspective, I hope someone gets in that first one, they break even, they make a few bucks, but they get all the experience. And now they can figure out, all right, I like flipping. No, I don't like flipping. I like to buy and hold. All right, that's what I want to do. So I think from an experience standpoint, I don't want them to get kicked in the teeth that first one.
Sure. So, like, you're in the future of where we are going. Like you're the track that, at least me personally, I'm going towards. And like, we're doing the podcast and we're talking to all these people, friends, whatever, and like encouraging this mindset shift. This, have you considered? Oh, you're looking for a single house? Have you considered buying a duplex? Like, I'm sure through the years, you've done that for hundreds, if not thousands of people. How has your success rate, I guess, been with that? Like, I feel like we had a friend on talking about stocks and stuff, and because I was trying to learn at that time. We wanted our audience to kind of learn about stuff, and it was kind of like, he's just like, dude, I don't give anyone advice ever, because if it goes good, they're a genius. If it goes bad, you told them to do something. So you've been in this teacher mode, mentor, helper, boss, that's been your track. Have you had guys, get into over their head? Have you had guys, get kicked in the teeth right away? And like, how has that process been?
It's absolutely happened. Okay. Absolutely happened. And what it is I share information like I want information shared with me. I don't want anybody to make a decision for me. Feed me all the information and let me be responsible for my decision. So when I start out with investors, or new realtors, it's like I'm going to give them all the information, and they're going to make the best decisions for themselves. So when they hit the home runs, or if they get kicked in the teeth, like for example, I've seen partnerships fail 100% because I see it a mile away now. Earlier in my career, I didn't see it, but you have the money person and then the sweat equity person, and they got this great plan. Everybody's thinking, oh, everything's going to work out great, and now you just know that it's never going to balance out. As much as it's so hard for the sweat equity person to understand the person with money and vice versa, like it's just because what happens when the project's 4 weeks late? Well, now the money person is getting all over the sweat equity person
who's been
and the
busting
sweat equity
their ass, yeah.
Who's been and imagine you're in the attic, you're in the basement, and someone's busting your chops, and you're like, I haven't been home in 4 Sundays in a row,
right,
and you're busting my chops, and it's because expectations are not aligned, and that's a recipe for trouble. So to go back to the question is that, yes, I've seen it all happen, but I've learned that I just share the information. There's no guarantee, and try to educate someone so they can make the best decisions for themselves.
No, I think that's really valuable.
And that's such an important part that I think a lot of people kind of stray away from, because with real estate, a lot of it's public information anyway. Like a lot of the deal information about it is public, but like a lot of times people don't like to share too much information about their deal, about their experience. It's not like you have to, you can be a private person and not, explain every single part of it. But I think it's important, especially with the age of information we're in now, to be able to share your experience to then help everybody else, especially avoid mistakes you've made. Like, I've made mistakes that I'll never forget and I'll never do again, buying this duplex I'm in now. And like, just things like that. Like we listen to Bigger Pockets, we hear their episodes, that it's all feel good information they have, you're going to be free, all this kind of stuff, but it's like not like the nitty gritty, like real information. It'll help you make the right decision when you're in the.
And there are pieces of it, like we listen to them, for a reason, because you can, by being a problem solver, you're able to take information and take the good, throw away the bad, and, build yourself up like that. And I feel like we both have. But the reason that something that we really wanted to focus on with this podcast was, I'm going to tell you the exact numbers. I'm going to tell you exactly what I bought it for, exactly how much money it took me to put down, how much I needed to save up to do that, what reserves I needed to feel comfortable and go to sleep at night. All that stuff is like super important. And like, that's this part, like we've had a ton of guys on even our podcast that like, they don't want to share the numbers because it seems boastful at a point. And I understand that too, but the purpose of this podcast is not to boast. It's not either of our goals to just, oh, look how great I am. It's like, no, this is everything. We were talking about in the beginning, like why we did the podcast. It was, oh, Jake bought this triplex, and there's a lot of speculation in the air. Maybe his dad had money, like little things that like, oh, maybe, something happened, this and this. And it's like to demystify that stuff. And it's like, you talk about these people buying millions of dollars of real estate, and it's like, well, how? Like, how did you save the money? Were you frugal in your lifestyle? Were you just rich from the beginning? Like, that stuff is super important. And that's what we've been trying to just like push out, is just that nitty gritty stuff.
Yeah, the full transparency, pretty much.
Right.
Yeah, and the truth is, I've seen it long enough that nobody wants to share the losers, and no one wants to say it takes a lot. It takes a lot and confidence to say, hey, I bought this, I expected this, and I ended up here, or I actually sold it and I lost money. But the truth of the matter is, every real estate investor has losers along the way, and losers by definition might be they literally lost money, or loser was, hey, they thought they were going to expect a 12% average compounded rate of return, and they ended up with 3%, right? Because when you really dig into it, now, I mean, and what's it mean after your tax returns and your write-offs? And you guys can, when someone talks about a return on their investment property, most people don't talk about the tax returns and the depreciation and getting all that stuff. So, I mean, it's great stuff to just be authentic and share it. And that's what you guys are doing. And I see that a mile away.
Yeah, I appreciate that. And I kind of wanted to like jump back and go back and just review some of the things you had mentioned before. You did speak about subdividing a property earlier, and that's something that I thought was really interesting because it just opens a door of possibilities. Because we're in the same area, so it may be different depending on your township or locality. But could you explain kind of how that process worked, of how you turned that 2 properties into 4? I think you said.
Yeah, 2 into 5, and it was a combination with the property we had purchased, and then there was a lot of building going on in that 2004, 5, 6 range, right in there roughly, and we got the idea that, hey, they're knocking down places. We had an older place; it was going to need more rehab after we had rented out a handful of years. And we went to the local municipality. We asked the zone to sit down with the zoning officer, and we said, we have this place, and we're interested in building a twin here, or maybe we're looking to put 3 together, 3 townhomes. And we were just a little bit short on the frontage, all right? Because when you go to the zoning office, they're going to tell you what the building envelope has to be and what can be built by right and where you need a variance, et cetera, et cetera. So we went and took the entrepreneurial spirit and went to try to figure it out. We actually took that. We went to get a variance, and a variance is a whole nother discussion, but it didn't work out because we were going to try to put 3 on our property, and that didn't work. So again, through failure, we learned oh man, we couldn't do it. So we went to the neighbor. We asked to buy about 4 feet of his property. He wasn't willing to sell it. So then we got creative again, and we said, hey, how about we combine our properties? And the way it worked out, I do not remember all the numbers, but basically he ended up with a brand new 2,000 square foot townhome with very little out of pocket, and we got the 4 other properties. And so that's what ended up. Again, it got really complex. It took a long time to do it, and then we ended up selling those properties to a builder. And again, you want to talk about getting kicked in the teeth and luck. We sold it months before the market collapsed, and we had no idea. We had no crystal ball. We had debated. Eric and I had decided, all right, do you want to learn how to build from the ground up? And we literally debated it. And I said, nah, I don't think I want to learn how to build from the ground up and going to get those types of loans. That wasn't in our wheelhouse. So we decided to sell it, and we sold it. And a developer who just still does a lot of work in the area, he made it. He still made money on it, but not nearly what he thought he was going to make because the market collapsed. Again, if we had held those properties months longer, it would have been a whole different story.
Yeah, no, that's crazy, but again, awesome.
It's a very we talk about getting creative with financing, and that's definitely up there of top creativity for that. Just being able to hand your neighbor a property for to get
that's seriously
awesome.
Here
that's
you get a new house, we got everything else that. I think that's super cool. So now you've done these deals. You did the FHA 4 unit. How did things go forward? The FHA, you did that straight up, no partners or anything.
Correct. I did that.
Was that your first deal with no partners?
Was that my first one? I think so.
Okay.
I think that was my first one with no partners. But I got to tell you, the lender I had at that time, I actually remember being in his office and him talking to get that one through. The lender was so key, and I still, whenever I see him, I still thank him to this day because I was on the phone when he was talking to the underwriter to try to get it through because at that time, whatever the underwriting guidelines were, and he's like, no, legitimately, this is an investor who's going to live there, but he's not buying it as an investment. He's actually going to live there. And I was actually in his office a few times where the underwriter was debating on some of those guidelines. And again, my point of saying all that is it's critical to have the right lender.
Oh yeah. We've had Todd and Dylan, two of our two guys that have went through all of our deals with. They're our lenders with Cross Country, and with this last deal, the only way that I was able to make it work with the purchase price and everything with the deal that we got was because they had that 1031 exchange coming. They needed, we had 4 weeks. I was like, hey, we got 4 weeks, or I think it was a little less. I think it was July or June 14th or 15th, and then July 9th was when settlement had to happen. So it was tight. And I was like, I asked him originally, and he was like, yeah, July 23rd, we'll have it done. And then I sent that back. They were like, can you do July? We can only do these numbers if it's July 9th. And the whole deal was because of him. and because of the relationship we have with him. Like he's a friend now, and like, you know, I would return the favor in any way, shape, or form that I could for him. So it's just like you said, it's very important. Do you have this? Have you been using like the same guys throughout? Have you had to switch up a lot? Have you know, your like core team of, you know, title, insurance, lending, like, are those guys like your guys, or do you kind of have you used a lot over the years?
It's changed over the years. I would stay with them for a while, but the one I was just talking about, he ended up going in and managing many mortgage offices. So he got out of because of different career paths,
Right.
And then buying an office and getting involved that way. So it's changed over time, but the relationships are still there. The questions I still go back to ask them for, but not everybody's not necessarily in the same spot.
Sure.
So, but to talk, but it's so critical to your point of building your team. Like it's building your team and being okay. Like for lenders, being okay that you might have a few lenders you work with, and because person A has this product and person B has this product, or working with realtors because somebody knows Souderton, somebody knows Lansdale, somebody knows Philadelphia. You know, it's building the team and having those critical resources. I think you are always building the bench, so to speak.
Yeah,
I think
you're always building. Yeah.
Sorry, I think it's just funny how the better somebody is at their job, like the shorter amount of time they'll be doing it, just because they're just going to advance that much faster.
Yeah, absolutely. You're so right on that. Yeah.
That's a shame. No, but it's good. The so now going past that, the FHA 4 unit, what was your next steps?
I think after that one, I moved in. At that point, I think the next place I moved in with my wife, Joy, right, who's my wife, and we lived in. So that's where I stopped buying places and living in them. If I'm remembering right, then we lived in another place in Conshohocken.
So then after this, back to partners, back to just buying as investments. Were you doing them personally? Or, you know, what was kind of the track going forward?
Partners.
Okay.
Partners for the next 2 or 3.
Well, that's a question that we've gone over on the podcast. You may have heard us talking about it. Is our partnerships a good idea for our situation? Should we have, like you said, the money and the equity split? Is that like a good, like, how does that work? You know, is it repeatable? Is it scalable? Is it something that's like something that would be a good replacement for the live-in, you know, buying a house, claiming residency, that kind of a thing? And I guess my question is, how do you tackle partnerships for your specific strategy?
Yeah, you gotta. It comes back to communication. Because if I team up with Jake, say, and I buy, like, hey, he likes the deal I have, and we buy it, then Caleb, you're thinking like, man, I wish I was a part of that. Or hey, I buy one, and you guys are like, well, I thought we were partnering on that. So it's if you're going to get involved with partnerships, as nobody wants to have the uncomfortable conversation up front, but you want to have that and think of all the worst case scenarios. And then if it's not going to work out, great. You don't have to get any attorneys involved. Right. But if you run into problems after the partnership's together, now you're fighting with attorneys. Now you're spending a lot more money with the attorneys doing it. So are partnerships good? Yes, but you just gotta. I guarantee partnerships over time will change. Not always for negative reasons, just life reasons. Mm-hmm. And you gotta be on your toes. So. And that's where, again, I mentioned earlier, you guys are doing so good. Eventually you're going to have people who offer you money, and you know, and all of a sudden you're like, man, I don't like that deal. I'd rather wait. And then the partner's kind of pushing you, like, hey. And then all of a sudden you concede a little bit on your values, just a little bit, and then you're like, man, I shouldn't have bought that one, but I bought it because we had this $200,000 in the bank, and we had to put that money to work. So if you're going to get involved in partnerships, eyes wide open and uncomfortable communication up front.
Have you had any horror stories with partnerships personally?
Personally, no horror stories, but I can tell you this, that motivations have changed over the years.
For you or for them?
For everybody in the partnership. Sure. And what I mean by that is we used to run down and do the painting ourselves. And we used to run down on a Saturday night and get rid of some trash at a property. But all of a sudden, you know, families start and things happen, and one partner doesn't want to run down there. All right, so you take care of it a few times. But when it's 5, 6, 7 times, and then all of a sudden, again, we're all still very good friends and everything is good on that end, but you decide not to put more money to it. And I've sold a couple places because all partnerships are on the same page, but everybody doesn't want to put the same effort toward it. So they don't break down because of bad communication. It's like, hey, I'm not interested to go on a Saturday night, and so hasn't been there 4 times in a row. So,
Yeah, no, that makes sense. What has been your role in your more recent partnerships? Like, what is, everyone comes in offering a certain value. What has that been for you personally?
It's the real estate experience, especially
Okay.
the property management experience, from knowing what the rents are, listing it for rent, doing the lease, doing the property management, all that stuff. So it's bringing that knowledge.
So are you doing that in lieu of cash as well, like, or maybe some cash plus that, or how have you been structuring things like that?
No, it's all been we're all bringing something to the table,
Okay.
and cash is pretty much the same.
Mm-hmm.
It's not broken up differently now,
Okay.
which I've learned is a very hard partnership to do. And that's why I'm not saying I would never do it again, but it's very hard to balance sweat equity and cash.
Right. That makes a lot of sense.
Do you have any like core principles that you apply to all your partnerships in real estate?
What I talked about is communication. So they're not written down, but communicate. And it doesn't mean text and email and all that stuff. Text can be efficient, but not always effective. You got to get out in front of it. I've learned to get face to face with people. So it's not many, it's just communication. I've learned communication through property management. When the tenant has an issue, I'll go down and meet them face to face. And because it's so, everybody can be a keyboard warrior. Sure. And say how bad things are. So my answer to you is just communication, and uncomfortable communication, and face to face or on the phone, or these days on Zoom, is what's critical to the partnership, because you don't want that to fester that so-and-so hasn't done X, Y, and Z in time. They might be running into a jam at home, but if you communicate, at least you have a chance.
Sure. No, that makes sense.
And yeah, especially like setting expectations, like you said, like if you want everything to be, equally balanced between the partners, having that conversation up front is just, when you're messing up as a partner, like you're not going to do the wrong thing and be like, oh, I didn't know, like you absolutely know. So when that hard conversation comes up, you're in the wrong because you set those up front, through that communication. So I think that's,
and if you,
go ahead.
Yeah. And if you add, 3 or more people, you got to be careful of people teaming up against the other person.
Oh yeah.
So now you're out Saturday night hanging out with one of the buddies, and you're a few beers in, and you're like so and you just start grinding on them, and that can wear, man, because all of a sudden someone gets in your head. Or a lot of time I've seen significant others at home wear on somebody. That reminded me of a partnership where 3 or so buddies got together, and they haven't talked in many years because it didn't work out. And because, from the information I gathered was that significant others were giving someone a different opinion, blah, blah, blah. And you got to be careful of the teaming up, so to speak, or somebody getting in somebody's head, especially if it's 3 or more.
What's your biggest group of partners you've been involved with?
It was that first partnership where that land we ended up subdividing. I forget if it was about 15 or so people. But remember, we were in our early 20s. And the smallest investment was literally $500. So we went out to everybody. We had very little money. Right. We went out to everybody, family, friends, and said, yeah, you can be in whatever you want. We would take anything. And we literally did a partnership from 500. And I forget if it was 10 or 15,000 was the biggest one.
That's so awesome.
And and it just made it work.
So when you were breaking down kind of your role in the partnership, what roles are other people filling in that same partnership?
You got the handy person, for sure, the person who's going to do the work. You got the person who's going to keep you guys on track. So meaning, hey, we got to meet monthly, we got to meet quarterly, we got some things for the partnership. Here's some things we want to do for the house. And then the other one is real estate related, just
right.
Market values, stuff like that.
Okay. So because to me, hearing those 3, you have an extremely valuable role, and the handyman has an extremely valuable role. The other one, like, hey, we got
the project manager.
The project manager.
As someone who's worked on teams before, and like across, especially like important, like involving a lot of other people outside of your core team, a project manager is something that's extremely important to keep the ball rolling, because without that, you get caught up in your daily tasks, and those deliverables or those awaiting on tasks just get clogged up, and then you hit a deadline, and then all these things are going to take even longer because you haven't been following up with these people on it. So it's a super important task for sure, because it seems like what you said was the deal management is what you fulfill, where you have the intake and the outflow of the real estate where you're buying and selling. You have the house management, the people who make the product, pretty much the, fixing everything up and dealing with all the issues. And then the project manager who, like I said, deals with the task flow.
Oh man, yeah, because you got left brain, right brain, and like you said, there's accountability with a project manager. I know I would always be trying to do better, and better, and that's why I need a good project manager to go, nope, we got to do it. It's race day, so to speak. Let's go.
So, with the handyman partner, do you actually have like one of the partners that's out there doing the work, putting the sweat into it, or is he just kind of managing the handymen and the contractors and stuff like that?
Both.
Okay.
So he's gotten so good now that he has a team of people who'll reach out to, and he'll do some work himself. And for the, once the properties are up and running, like we'll pay him as a regular contractor for the maintenance items. That is, as you guys know and will continue to know, knowing a good handy person is such a key. I would pay top dollar for a person who is going to communicate with the tenants, who's going to take care of it and just do it the right way, and is going to say, hey, this job needs the $300 job, but hey, you don't want to hear this, but this is a $2,000 fix, but you're going to fix it for the next 10 years. Mm-hmm. And the right way to do this is $10,000. So you have trust.
Yep.
And when you have trust with a handy person, like I do not even ask for estimates, not quotes, and I pay them right away. Like I've learned that through my own property management. Matter of fact, when somebody comes on board and someone wants us to manage a property, just as much as they interview us, we interview them, because it's like, hey, I want to let you know we're not going to get the cheapest person in town.
Right.
We believe in customer service and taking care of tenants, and we're going to get the job done, as opposed to looking for the cheapest person, et cetera, et cetera.
No, that makes a ton of sense. I've been confronted, like you said, like people, you seem like you know what you're doing. I'll bring cash. I can. Would you be interested in doing something like that? And then I, start to think about, okay, this person's going to bring cash and put their hands up, and then I'm going in and I'm thinking about all the different variables. Okay, I'm managing forever. I'm going to be responsible for fixing stuff or paying someone to fix it. And part of my value that I feel like I have is the ability to do a lot of that handyman stuff myself. When it comes down to that, like in the partnership, like you're saying, I wasn't sure really how to break that down in the fairest way, because it's like, okay, I can either charge what another handyman would charge, or I don't, and that's part of my equity, and we split the cost of materials. And how do you guys normally handle stuff like that?
It can go both ways, and that's why over the years we've talked about it up front.
Okay.
So everybody's on the same page. Both ways work, absolutely. Mm-hmm. But all partners have to be comfortable with, hey, it's going to be time and materials, or hey, because what is the value to the fact that you want to go out on Friday night, but now you got to run down and do the plumbing repair, right? Like, so you could pay a plumber $85, $1.35 an hour, but you just got to make the decision, like, hey, I was supposed to go out with my buddy, and now I got to go be there I've been at properties at 2 a.m. I've been there.
Right.
How do you define that in a partnership? It's really tough. So there is no perfect answer in the way you're going to break up the partnership, but talk about, hey, I'm going to apply this to equity. We'll recalculate the Google Doc at the end of the year, and I'll keep track of everything, because what ends up happening is that you shouldn't wait a year. You should do it every month. So if there is a dispute or disagreement, you solve it then, and everybody's on the same page. Because the second that I say, hey, that job you should really only apply $500 to our equity, because so-and-so, someone's not going to be happy.
Right. And it's funny that you say that too, because I talked to a bunch of people about that as well. And kind of the conclusion that I made in my head was like, okay, based on everyone that I talked to, is like, revisit at the end of the year, disperse payments at the end of the year, talk about, stuff like that, keep your reserves up. And then, okay, now we have this bank, do we want to do another deal? Do we want to take our cash? Like, but you're saying it's more beneficial to do monthly.
Well, yeah, it keeps those issues smaller.
Which makes
if you
sense.
let them build up, you come to the end of the year and you have 6 discrepancies, versus 1 at breakfast.
Right.
It's going to be a much different conversation. I think when we ran the numbers on the cash equity split, it's just like there was no, like you said, no clean way to define how the equity gets applied and then how the cash gets split. And then you just kind of have to just agree, is it going to be a 50-50, 60-40? It's how much work is it? How old is the house? How many calls are we going to get? So yeah, I think what you said about it being a tricky conversation, regardless of how you split it, is just, the only answer to it. It's entirely up to the scenario.
Yep. And you're going to, by meeting monthly, there's something called in the science and, all the fancy smart people beyond me, it's talked about healthy conflict. So if you get together with your partners and nobody says anything, there's probably somebody who has an issue. They're just not comfortable bringing it up. So by forcing everybody to talk about it and creating healthy conflict, this is getting way deeper than.
No, I actually just read a book about that, like the ability to have a team have a conflict with each other and then work through it, strengthens the bond between everybody. And that fact that you care enough to have a conflict about it, shows that you want to actually get to, the other side of that conversation.
Yeah. And because when people get fired up, it's emotional, and it's so hard to listen when you're emotional. And that's what I talked about a lot in that negotiation course I just taught. Like, you're trying to negotiate with someone, but they're fired up and they're not listening. And it's the same thing with a partnership. Yeah, absolutely.
Yeah, no, that's I think it was called Daring Leadership was the book. It was a good one for sure. Something that I wanted to ask you about was, how is the property management business been for you, and what are your plans for the future? Are you planning on scaling it? Are you planning on separating it from your real estate, like the agency part of it, or what are your plans, and how's that been?
It's a great question. How's it been? We've learned a lot. We've grown a lot. And along the way, we've come across, 2 property management opportunities to purchase other businesses that didn't work out, that we didn't get to the finish line on. So it goes back and forth. So I have no perfect answer on it today. But it's from a realtor perspective, it's good because you make a few dollars on it. And you build a lot of great relationships. Mm-hmm. And then all of a sudden you take care of someone and they're an investor and they appreciate it. And then they're like, hey, it's time to sell this one. Or, hey, it's time to 1031 this one. So there's a lot of synergy that can come from it. But it's not, property management is not the most exciting thing in the world. It's blocking and tackling. And most of the time someone is not happy, whether it's a tenant, an owner. It's just not a very rewarding business.
Yeah, no glamour in property management for sure. And I guess another question was, how is it different for you to manage handyman versus realtors? And how's that been for you, that difference?
It's been good in the sense that I've learned through failure. Again, my lack of communication causes the problem. So, I can learn if someone is going to be good at what they do and if they're going to follow through. So I think teaching, coaching, and training agents has helped me in my communication style and my ability to work with handy people and contractors. And it also, I can see a mile when I come across someone who's great, and I have a few of them, it's like, do not lose them. Mm-hmm. It's like property managers, if they're going to charge X, Y, and Z, but you guys, if you get to the point where you use a property manager, don't worry if they charge X, Y, or Z. You find that person who is just really good at what they do, pay them for X, whatever it is, X, Y, and Z. Because I've gotten those calls. We don't do the city of Philadelphia, and someone will ask for a referral, and I'll pass along a referral. And I'm like, whatever you do, get comfortable with the property manager. Do not worry. Yes, you want to worry about the rate, but don't price shop. Do not price shop, because every time your place is vacant, every repair, you want someone to, first off, no one's ever going to take care of a property as good as you are yourself. Yep. And if you're giving it to a property manager, do not price shop.
That's really valuable, good piece of advice, because I could see myself finding the cheap,
absolute bottom dollar.
Yeah, because
property manager.
That's how investors work most of the time. We're trying to find the best deal, but the deal is the value. Trading that value, if it correlates.
Well, the value is you not having to do it.
Exactly. So I'm saying, like, the value in a crappy one is nothing.
Yeah.
So like they're paying a lower rate for no value.
Yeah, it doesn't make any sense. And
when you guys get that $700 bill, you're going to want to know that the person who charged it, and whether it was the property management or the contractor, if you trust them, you're going to be good with it.
Mm-hmm.
But if you don't trust them and you get that $700 bill, you're going to be like, wait a second, what happened here?
Right.
And so again, you might have saved on rate, but now you end up with the $700 bill when it could have been $425.
Yeah. No, that makes sense.
What area do you guys do?
We cover, if you stuck a pin in Conshohocken and you went out about 7 to 9 miles from there, that's roughly the range. We'll stay. And if we get someone further outside of it, we'll have a conversation up front. Maybe it's somebody we know, and we'll let them know that, hey, our core people aren't out this far, but if there's a spot where we can help somebody out, we might help them out at that point.
Are we talking about just property management, or are we talking about where your agents service as well?
Oh man, we got 39 agents. Conshohocken is the middle. We cover, you can circle 20 miles around all the way through Philadelphia up to the Jersey line, and then way out into the burbs. I mean, with 39, we picked Conshohocken because it's a central location. Yep. Nobody has to come to the office this day. Everything can be done online in the cloud and Zoom and all that stuff. So it's an amazing range that we've built over the years.
That's awesome. I wanted to go back to the communication on initial partnership and asking the tough questions. What are a few of those tough questions that you think are extremely important? Like, I'm sure there's a million, but what are some key ones that you shouldn't miss?
The key one is, hey, Mr. or Mrs. Partner, if this goes south, what's our plan? Meaning we each put in 10,000, 25,000, 50,000. If it goes south and we have to put in more money, how much do you have? How deep are you willing to go? The second thing is, because somebody will say to you, hey, this is the 50,000 I have. I do not have anything else. Cool. You know that up front. Mm-hmm. And someone will say, look, I'm in 50. I got another 25. I do not want to spend it, because everyone wants to talk HGTV when you should be talking about the other stuff, right? Yep. Let's talk about, hey, we got to spend more money, because that's another part of partnerships, is that sometimes there'll be times to put in money because, hey, you need the new roof, and you didn't think you would need it now, but you know it's going to be a good investment for the long term. But all of a sudden, someone doesn't have 5,000 a partner to kick in, and then what do you do? So have those. How much money are you bringing to the table, and what do you have in reserves? The other thing, as we've been talking about, is the sweat equity part. Like, hey, let's be clear about this. Who's dealing with the calls on Saturday night, and then figure out the sweat equity part about it. Because it's so frustrating for partnerships when somebody has to get the text from the tenant, and because you're not hiring a property manager, you get the text and someone's got to deal with it, even though all you're going to have to do is reach out to your plumber, or let's say you just reach out to your plumber. You still have to deal with it. Mm-hmm. And then you got to coordinate getting the plumber in. You got to coordinate with the tenant, like how they're going to get in. You got to put a lockbox on. Yep. Will the tenant be home? And then the plumber is going to be running late because they're busy. So again, the questions are, hey, how are we dealing with the day-to-day management?
Have you structured a partnership where in the initial buy-in you're creating your reserves?
Yes.
Okay.
Yes, we put in. So, those early transactions, it wasn't much money, but if we needed 12,000 to get started, we'd put in 15 or 20. Yes.
Yeah. Because then at that point, okay, because that was kind of my thought when we were thinking about it, was like, okay, the reserves are 20,000. No matter, for the most part, that will cover everything. And before any of us gets paid anything, that bucket has to be at 20,000 always, no matter what. So we might be having a few months that no one's making any money, but it's because of keeping that reserve up. Is that something that you guys practice as well?
Yes, you want to have that set mark. And you guys, I don't think have seen it quite yet, is that you're going to go through markets where it's hard to rent the property out. So you're going to end up with 3-4 months of vacancy. Mm-hmm. Like, it actually happens. Like, the market's going to change. I don't know when, but it's going to change. Yep. And you're going to go through 3-4 months of vacancy. So all of a sudden that 20,000 is at 9. Yep. And now it takes a long time to build back up. Or you thought you could get 1,400 for the place. You tried it for 2 months, and now you realize you should have only got 1,250. Yep. One of the most common mistakes I see, again, it's a very strong rental market right now, but just for the future, is that someone will think just because they got $1,400 in the past and the market gets a little bit softer, they'll try to get that 1,400 instead of lowering it to 1,250, realizing that after they miss 1 month of vacancy, they'll never make it up.
Yep.
And they'll hang on too long because it's like, dude, I got 1,400 for this like 3 years in a row, and now I got to get 1,250, and I'm like, look, I'll do whatever you want, but I'm telling you, if you don't get that in the first 2 weeks, lower it right away because you will never make up the difference if you're using financing.
That's an amazing tip there because like
Seriously.
we're both starting off in like one of the hottest markets.
It's like it'll always
ever.
go up.
Like it could literally never go down. You know what I mean? That's like the mindset so many people have, and like I feel that in my own mind that like it can only keep going up from here. But obviously, you know, we all know that's not the case. It's gonna go down eventually. So yeah, being able to, you know, hedge your bet against how much rent you're going to get for the month and be able to, you know, take a better side on the lower end to avoid that 2 months sitting on the market with never getting a bite because that price difference is huge.
Yep, and the market will change over time, and as long as you're, again, to the point of a partnership, being prepared for it, because if you have 5,000 in reserves and then you eat that up, and now it goes back to, oh man, we don't have anything in reserves, and now you're going to make it up over time. Don't get me wrong, but the cash flow in the short term can crush partnerships because person X just doesn't have it and person Y does, and it gets crazy.
Yeah, how does that conversation go? Do you guys just meet up for a meal sometime? Be like, hey, reserves are gone. We need $2,000. Like, whip out your wallets, or like, how does that work?
Yeah, we try to project ahead, and then what we've learned over time is what we'll call a turn, and it'll be like, all right, we're a year away. We got tenants in for a lease. Let's just say they leave, and then we got to clean, we got to paint, we got to shampoo the carpets, update it, and then so we always want to make sure, and it'll be vacant a month while we're getting everything rolling. So we want to make sure a year ahead we have enough money in for the turn, so to speak. Yeah. So we anticipate that it's going to be vacant a month or two. Mm-hmm. We're going to have to paint and carpet, try to build in maybe a worst case scenario, but not the best scenario. Yeah. And that way you're planning ahead instead of waiting until the last minute, because you'll find that your partners want to manage money differently. And what I mean by that is when one of your partners says they have no money in the bank, they literally have $0. And another partner will say, dude, I don't have any money. And they're sitting on 15 grand, but psychologically they don't think they have any money because that's their threshold. Yeah. So you're going to learn when somebody says, I don't have the money, it's like, you really don't, or you don't want to put it into this partnership because you have it planned for whatever.
And having that talk right away is the understanding that. I just feel like not a lot of people, if they were asked that question, would necessarily know that about themselves. I know me personally, like, you know, it would have to be, I'm more in that 15 and over 1,000. That's like, I have no money. Like we've got assets. Like I need this money to make sure that these things are okay. Like if that goes to zero, you know, what am I going to do? So like I'm definitely more in that place of reserve, and I would probably want someone to be similar, have a similar mindset to start with. You know, I don't know if I would necessarily want to partner with someone that is, you know, willing to go to zero. I mean, maybe, I don't know, but that's
I think partnerships, the success is when you have different brains and different mindsets. And so, you know, we talk about different strengths and weaknesses. So I agree. You don't want not somebody who's necessarily going to go to zero, but you want somebody who has a different brain, so to speak. Right. And it's like, man, I never thought about, I would never do it like that. If I've been successful at anything, it's because of the others around me, and no doubt about that.
How do you find that, like, that difference, the different strengths, the different weaknesses? Is that just like something you get with networking with people where you notice like, hey, that person's good at what I'm not good at? You know, maybe, you know, I should start talking to this person, or is it kind of like a natural thing that you guys just eventually just started working together?
Yeah, well, with my buddies I grew up with, I know them well. And then you just learn, you meet people, and you either feel comfortable, you know when someone's BSing you, and they only talk about the good deals and only the good stuff. And then there's other people you're like, man, I really like that conversation. And it's your ability to go, man, I never thought of it like that. And they're putting down 15, let's say they put on an FHA deal, they're like, man, I'd rather put down 15% to get better cash flow. And you're like, no, let's keep it in the bank. their way isn't necessarily wrong.
Right.
It's just they project their cash flow differently.
Right.
And that's okay. And you're either like, well, let me run their numbers. Let me not get stuck in my 3.5% down money in the bank. Let me see, because they're like, well, in 2 years we're going to end up here. And whether you agree or disagree, it's your ability to look at their ideas and to go, man, I never thought about that. If we do 15% down, we're an extra $150, $200 a month, $2,400 a year, and in 2 years we're in a little bit better spot. So you can go a million ways.
Yeah, no, that's a really interesting point of view. I'm curious when we were talking about the rents decreasing in a slower market. You're a property manager. You're responsible, not only for your own stuff but for other people's stuff, keeping them occupied. That's the number one goal. So like from your perspective, do you shoot low from the hip? Or are you like originally just like, the benefit of keeping this occupied and having zero vacancy is much better than an extra $100, so we're going to go a little lower? Like how do you kind of attack that personally?
Well, from a property management perspective, I have that conversation with them ahead of time. And the people I manage for, I get to know really well.
Okay.
We're the type of property management company where the owners are involved, so to speak, as opposed to there's many different kinds of property management companies, and some are completely hands off. They don't want the owner involved at all. We're still at the small size and I enjoy the conversations and relationships, and we keep them involved. And I let them know, because they'll be like, Matt, how high can we get? And I'll tell them there's a risk on vacancy, and everyone's risk ratio is different. So we'll have those conversations ahead of time to educate them on it and say, hey, let's test them. And a lot of times, if they want to go the higher number, we'll test the market 2 weeks and then get it right down to that number. Because I'll tell them up front, except for some of the people who own it cash, own it outright, they have a little less worry. But gosh, if you talk about having it during the winter time and now you have a vacant property, not only do you miss out because your rent's high, and now it's getting November, December, January, now you're worried about freezing pipes.
Yeah.
And not only are you worried about freezing pipes, who's taking care of the snow, and if it's not a multi-unit, who's taking care of the snow and keeping an eye on the property, all that stuff.
What's your longest vacancy you can remember? When was that?
It's probably been 6 months over the years, but I've been through some in the last 21 years. I've been through some down markets,
Sure.
And it's because of, again, the learning curve, my mistakes. Most of them are my mistakes, and it's because not as a property manager, not having those. It's my not being as good at my communication or as confident, and just saying, look, I'll put it there at that number, because someone might look at the realtor and go, well, he wants the lower number so he can get the additional commission on the property management. Like, no. I mean, that can be true. I totally get that conversation, but no, let's talk about, I'm about the long-term relationship. So let's talk about what this looks like over the long term. But yeah, I think it's been many months in different markets, and just because someone's set on their number.
Yeah. I actually really like the 2-week rule, testing the market, because we both, every unit that I've ever put on, we use Facebook Marketplace for everything. And it's like,
it's instant.
Oh my word. In the first day and a half, we have 150 people reach out. It's like, did I go way too low? Is like kind of normally that if that's the case, that's normally what's happening. But it's like, I don't feel that it's low. Like I'm constantly looking at what places are renting for. I'm constantly seeing and it's like, I think I came up with a pretty valid number. And then, to get that response, it's like, what the heck? Like that, it doesn't seem right. But by doing the 2-week thing, maybe you get a couple, and maybe they're bad tenants, and then you lower it down. I think that's a good strategy.
For sure.
I think I'll definitely,
like with this unit in the duplex that I bought, I had the place rented in less than 2 weeks. So that's definitely like an absolute usable timeline to either get good news or bad news to then go forward with changing the number, because if you have a leeway of time before the tenants leave the place, you can actually avoid any vacancy whatsoever by using that shorter time frame to test the market at that price.
Yeah, and the market is the real estate market, in my opinion, is inefficient. That's why you guys are able to find deals in this crazy market. And the rental market the information is very inefficient. And the only way to do it, regardless of years of experience, is just to test it out and be quick with it, be unemotional as you can be about it, and test the number and be like, man, I've gotten some numbers lately that I never thought I would get. And just because I've said to an owner, like, this market is a little crazy on the rentals, you want to try this? And he's like, Matt, no, I don't want to try that number. I'm like, all right, you don't have to. I just wanted to mention. He's like, well, maybe we'll just try it for a week. And got numbers that he never thought he'd get.
Right. Yeah, we're seeing the same thing. I was just last night creating a binder for I inherited some tenants, so they were paying way below market on this new place, and so I took everything that's available within, I think it was like 10 or 12 miles of our property. Every apartment that's available that's a comp to their apartment. I put them all on a paper. They all had, I saw their square footage and all this stuff and what was the closest to them. And it was like my average for a 2-bedroom in Quakertown, which theirs is a 4. It's a 2, but because the 2 on the 3rd floor isn't technically 2. I need to add baseboard heat and stuff, but it's finished. But anyway, it was like $1,600 was the market average right now,
which is almost double than what they're paying right now, which is crazy.
Right. So it's like I broke all that stuff down, explained, I want to keep you guys, if I would list it right now, it would probably be for around this. What do you think is fair? And like kind of putting the ball in their court so that they can, make a decision. And I told them, like, I'll keep you guys on a month to month if you want. If you want to keep shopping, like, we can work something out like that. And
this is Dion McNeely's strategy, the binder method, and he tries to get them to sign a longer 2-year lease so he can get the higher, closer to market rent without doing a turnover, and then get the lease signed with the same tenants at the higher rates, and then keep them around for a lot longer.
Yeah, so it's just wild because I have in the same town 3 other 2-bed, 1-bath. One's a little bigger, and they're not rented for that much. But I mean they're not bad. They're 1,300, 1,400, but still, like, in comparison, it's like, is it? I don't know. Is
it worth it to try and squeeze every dollar out of these properties? Yeah, I don't think so either. I think there's a balance for sure because, like you said, the market's gonna eventually go down. You'll have some slow months. People may start shopping around for cheaper apartments, and then you're stuck holding the bag with some vacancy.
Yeah, guys. It's for 21 years. It's an art and a science. And it's more art than science, and you got to. You're going to look for, again. It gets so frustrating. When I was a similar age as you guys, is just looking for the answers, and nobody would give you the set answer. Mm-hmm. And I promise, for the next 20 years, it's going to be inefficient in the rents, and sometimes it's going to be on the low side, and sometimes it's going to be on the high side. So it's your knowledge and experience that's going to make the difference, and your ability to react quickly and go, all right. Got 1,400 the last 3 years, and it's not there. Let's move quick. Let's get this down to 1,250, because psychologically it's a loss. Mm-hmm. But in the long run, and where you guys are going with your investments, it's not a loss, right? Because you're solving the problem quickly. For that year, 2 years, you're at 1,250, but it'll get back up to 1,400, and then it'll go above it.
So do you personally, do you see that? Okay, we've got the market is this. The market's at this set amount. But I know that these tenants will stay for, 10 years. Is there the benefit there in locking them in and seeing no vacancy? Or is it still kind of that art and science? Like, you need to balance it. If you keep them at a low rent, always you're just losing out on money. So, like, how do you manage for other people the same exact way you manage for yourself?
No, I go from the education perspective. Like, I tell them what I do, and a lot of times I build relationships where they're like, Matt, what would you do? Yeah. And I'll tell them, but no, I provide information. Okay. And then some people are more aggressive, and some people are pretty conservative. And I have some investors, the cash ones, who, like, they're comparing it versus money in the bank is earning less than 0.5%, right? And they're like, that's their frame. Yeah. Is like, hey, I don't care. I just want to don't challenge the market. I just want someone in there quick. Like, no, do not. They could literally bet 1,100 and possibly get 1,500, and they're so set in their way, and they're very successful. and they just want 1100 because that's what works, no issues, just keep it rolling.
Yeah.
So from a property manager perspective, you're just providing the education. In general, can be good to lock people in for the long term, because what's the cost of the turnover from maintenance, wear and tear, if you're going to hire a realtor to list it, commission, and just the headache of it, the sweat equity part of it about it. But I'll tell you where people struggled is that the people who purchased property 15, 20 years ago were in a historic market. And if you're locked into a 2-year lease, you don't have the opportunity to sell it without tenants right now. So nobody could have predicted the pandemic. Nobody could have predicted this historic run up. But there is a little bit of a downside to locking in for the long term, because life changes, stuff happens, and you can't move on and you have tenants for 2 years. Again, I think most of the time it works out for the longer lease. But I wouldn't assume it's the best way to go. Right. Now, you could still sell your home with tenants in there, but you can't, in my opinion, you don't maximize value because it just doesn't look as nice, all freshly painted, new carpet, all that stuff.
Yeah,
absolutely. Was COVID a large change to your daily life, your business, how your strategy, your outlook on life? How did that kind of did that have any large impacts on you?
Yeah, it changed the real estate industry for the better. It sped up technology, and it made us better if you were willing to embrace the Zoom and the online, and just it made the industry better. But it changed it where prior to COVID, it was very, very rare to do a virtual showing, meaning I'm in the house on FaceTime, Zoom, whatever, and now it's pretty common. It's no big deal if you're in North Carolina, and I have friends moving up from North Carolina, and they saw the house on FaceTime.
Yeah.
And so it literally changed for realtors the day to day. The realtors who didn't embrace the change, I think, have struggled and continue to struggle today.
Did you see it on the property management front? Like, did you see people taking advantage of the eviction moratorium and everything like that? Or were you, like, we were both lucky we didn't have everyone paid on time, but I know that's not the case for everyone.
Yes, I've seen different ranges of issues, and again, I don't necessarily say took advantage of it, because some people were truly impacted by it. But there was a whole bunch of you had to be, from a property management perspective, all of a sudden. That's a great example. We're talking about partnerships, because if you didn't get that rent for 6 months, and if nobody could have predicted it, right? No, right. That's okay, but now you got to deal with your partners. But yes, I did see a range of different issues. And again, most of them, not all of them, are solved with communication. And I'm not talking about email and text. And certainly during COVID, it wasn't face-to-face, but getting on the phone.
Yep.
And I will. One of the secrets, or the hacks, so to speak, of any tenant issues is getting on the phone with them, face-to-face if you can.
Yeah. But
getting on the phone, because everybody can be a keyboard warrior and say this and do that behind a text, and it's the written word. It's less than 10% of communication.
Yeah.
So I rambled on there, but it's just it absolutely saw a range of different things during COVID.
No, for sure. That makes 100% the difference between having somebody being super angry while you're talking to them versus you're trying to figure out what the problem is, and they know you're trying to solve the problem for them, versus you ask them a dry question over text, what's the problem? They're like, what's the problem? I'll tell you my problem, and it's just it's I can see that going. And what part of the movement with COVID, do you guys leverage virtual assistants in your day-to-day work, or have you guys embrace that new wave or fad at all?
No, we haven't gone. I mean, we do we've embraced, the virtual showings, but not so much virtual assistants yet at this point. But it's a changing industry, and we will over time. But right now, it's just the ability to Zoom and people to pick places out, potential renters, without actually going into the property. So having the technology that we all have, to be able to see it and do it. But we still have more to improve.
So now, we're nearing the end. I feel like we could talk to you for, 5 more hours, but we don't want to hold you anymore or too much longer. For someone who's been in for 21 years, who started at 24, talking to two 24-year-olds, a lot of our audience is around that same age and stuff. What if you had any, like, a few tips or just like little things that, I know you've shared a ton on this podcast, but like anything in particular that like you wish you knew when you were 24 that you think could be valuable for some of the rest of us.
Yeah. I think it's that quote. I forget who said it, but you're not right because others tell you you're right. You're right because your facts and reasoning are right. So be careful listening to others and just pave your own way and listen to those around you for sure. But if they say no or yes, don't rely on that. You're right because your facts and reasoning are right. And if it goes well, awesome. And if it doesn't, you've learned a lot more. The second thing, it took me a long time to understand this it took me a long time to understand how inefficient the real estate market is. And I mean it like that. So I built really good relationships with a lot of people over the years. And I could take 3 investors into the same property and come up with 3 different values. And people don't understand that. And I certainly didn't understand that at 24 because it's like, well, partner A or person A, they're an all cash buyer and they want to rent it. They just want to do better than their money in the bank. And partner B values it like, hey, they're a first-time investor and they're 20% down or they're 3.5% down FHA and they value it like that, but yet they're not handy, so they have to hire it. And then investor C, they come and look at the property and they are handy, so they can spend more because they're going to do all the work themselves. So it's understanding how inefficient the real estate market really is. And by you being confident in your knowledge, you're going to realize that just because Matt's been in it so this many years doesn't mean he's right. Like it's just a piece of information. So it's inefficient. And the 2 to 4 units are even more inefficient because I certainly didn't know this. I really didn't know this till I bought that one. But because as realtors, there's a lot of amazing realtors out there who are good at selling and buying and selling primary residence, but they don't understand cap rates. They don't understand net operating income. And what you have to understand is that the data that's put into the MLS is from the realtor or the owner. And it is so inefficient, as you guys probably see.
Oh, yeah.
That realtors, and I've heard you mention it on past podcasts, they just don't market it the best way possible, I'll say. Yep. And again, it's just because they're just not investors. They don't understand the difference that quadplex has 4 separate heaters and that the real net operating income you're seeing on the MLS really has all the expenses versus the one that just has the taxes taken out.
Yep.
And it's so inefficient. So I think I didn't know that again until I went through my mistakes buying a quadplex and learning and going, wow, it's so hard to compare cap rates at 2 to 4 units because again, the numbers, the data, it's messy.
Yeah, the comps don't add up. You've got people buying a duplex for their mother-in-law, using it as an in-law suite, and now they're paying, market single-family home when the rents will never come close to what the mortgage would be on that.
It almost seems like people try to make it as dirty as possible. Like when they're uploading the listings on the MLS, they're like, how can I make this as terrible as I possibly can for people looking at it? It just seems like a consistent trend that I can see.
Yeah, I would say I view it. From my experience, it's just because people don't know, and as the realtor, I get bad information from the owner or lack of information. Not bad, but they just don't give me a lot, and I have enough just to put it into the MLS. But most don't. It's a niche area, the 2 to 4 units, because you're not big enough from the commercial side yet. You're still on the residential side, and a lot of people buy them. They live in one, they rent out the other. That value is totally different than someone buying it and they have a family member live in it. Because their frame is like, hey, instead of $1,100 for mom to pay this, I can have her live in one.
Yep.
So oh man, there's many reasons that the numbers are messy.
Well, like you said, it's an art and a science, and we're all painting different pictures here. Some better than others. So it's kind of just comes down to everyone's experience they have going on, because this isn't a financial game for the multifamilies. It's a lot of feelings going up, and because like you said, they're not commercial yet.
And that's been to our benefit, actually, the dirty listings and the terrible 2 to 4 unit, because they're getting these, like you said, these residential real estate agents who do not understand investing, and all the 3 of my deals have all been taking advantage of that, because it was put in poorly. Because
they just left so much money on the table because they just didn't know what they had.
Exactly.
they not only whether it's, they didn't know what they had, but they also, you guys view it, you have a long runway ahead of you.
Mm-hmm.
And someone might be coming to the end of that runway. So they view it one way because they started 20 years ago.
Right.
And then you guys are like, well, rents start here, and over the next 20 years, we can raise them to X, Y, and Z. So yeah, there's many, it's just understanding, again, the question was, what could you know now? Is that just people view it differently. I guarantee if I walked into the same multi-unit with you guys, I would just view it differently.
Yeah.
And it would just be sharing the information going, oh, I didn't think of that. I'm more confident in that number, less confident in that number.
Mm-hmm.
And you might see that the heater's 17 years old, and then you're like, man, I don't even have to think about that for another 8 years.
Right.
And I'd be like, no, like at 20, let's plan on having that $7,000 replacement.
Yeah. No, I think that is a really fair way to look at things. Like, we all look at them differently. And just by knowing that, like, how are these people paying $30,000 over asking? They look at it differently than we do. Like, and that's okay. If they're beating the bank, what's wrong with that?
Yeah, it's just, making your strategy, sticking with it, taking all the information you could possibly get. And then, like you said, not listening to everybody around you saying that, it could be wrong if they have no idea what they're talking about, especially, and just, getting after it.
Yeah, getting after it and knowing your numbers. And it's not that they're overpaying. They're paying over list price.
Right.
But if you know your numbers are tight, and one time I saw this in Conshohocken many years ago, somebody bought a place, $50,000 through the estate situation, through a family member, and they turned around and listed the property for $120 a week later. And I remember this is many years ago, one investor's like, I'll never pay $120 for it. He bought it for $50 from the estate like a week ago. Like, it was a very, very short time frame. I'm like, it shouldn't matter what somebody bought it a week ago for. It's like, what are your numbers? And I think a lot of investors struggle with that because they get caught. Again, it's emotional. It's not logical. It's emotional. Like, well, if they just bought it for that, no. Here's my Google Doc. Here's my numbers. I've locked in this rate. And if rents go up or down, I got some vacancy, I got some maintenance in my Google Doc, and let's go.
Yeah. No, that's a really good perspective. How can people find you?
Yeah, feel free to reach out. The realestategps.com is the brokerage website. My number 610-960-1786. Happy to continue to share with you guys and basically just be like you guys and be authentic and just share all the information.
That's awesome, man. And so you said you were doing like, the coaching and all that kind of stuff. Is that all through the same thing, or do you kind of have a separate entity for that type of stuff? How do you publicize your classes and stuff like that? Like, if someone was interested, how could they be a part of that?
Just reach out to me, and I'll keep them up to date on the classes. I teach at a lot of different real estate schools. For the agents in our office, we do one-on-one training, and that's our bread and butter, is understanding the individual and one-on-one training. You take a golf lesson with a group of people to be okay, but you take a one-on-one golf lesson and the instructor will tell me how much I suck, but at least I know exactly I suck for those reasons. So yeah. It's through a lot of one-on-one training. And again, if someone just gives me a buzz, anytime I'm done the classes, I've taught to, it might be close to thousands of students now.
Wow.
And everybody has my number and they can just reach out because there's nothing to hide. Like, let's share all this. Again, it's just that same property has different values to everybody. But it's funny. I just want to mention this because it reminds me, because someone will come in and meet, whether it's me or one of the agents in the office for the first time. And they're like, well, how do you work with other investors? Like, you're going to give them all the deal. And the new investor doesn't understand, like, no, the same deal is not the same deal to everybody. It's not. Right. It's just not.
Absolutely. No, there's so many ways to skin a cat, and like a lot of people are going to see everything very differently. And, I could definitely see like the training, like you were mentioning with the one-on-one, having, seeing exactly where your baseline is, where you're starting from, how to grow as a person from there and like getting better. I think that's super beneficial. And we both, like you especially, talk about getting your real estate license. So is that something you recommend for investors, for them to get? Is their own license?
I recommend if they're going to learn the industry. Mm-hmm. And what I mean by that is some people view realtors as an investment and others view us as an expense. So if you're going to get it and you're going to learn the knowledge and learn how to be a realtor and how to represent yourself well, go for it all day long. But if you're just going to get it,
to eliminate the expense, That's not the way. Okay.
You're gonna go through the learning curve again, and it'll catch you.
Mm-hmm.
It'll catch you because look, but it's well worth it over the long term if you're going to get in and figure it out, and you'll learn how to negotiate better on your half. You'll learn the paperwork better. I mean, I just spent 6 hours with a group of realtors on how to structure an offer, and when they left the class, they're like, "Matt, we wish this class was 2 days long."
Right.
And so you can go really, really deep. I'll give you one example just from that class. Is that how do you submit an offer to the other listing agent? And the question was, and I had them break up in groups, do you put it all piecemeal into one offer, or do you have separate documents? And they're like, well, why does that matter? Well, because if you put it all in one document, now you control what the listing agent and the seller see. So now you've merged it all into one document, and you want to show them that you're a really strong buyer. You put the BFI, buyer's financial information, the pre-approval in the beginning. Because what does everybody jump to? Everybody jumps to price.
Mm-hmm.
So again, it's just one of many things, but it's just like, how do I call the agent, I text the agent, but how do I submit the paperwork that is most likely getting forwarded to the seller? And the seller is probably looking right at the number. So what do I want that seller to see first thing? Now, if I'm a weak buyer, which is okay, and I'm offering $325 for that place that's listed at $300, I might bury the pre-approval and the BFI in the back of the offer. So the first thing they see is $325. The seller is then excited to see that, oh my gosh, I listed at $300, I'm getting $325, and they're less concerned that it's the buyer is not they're just not as strong as the other buyers.
Sure.
So my point is saying, so if you're going to become a realtor, you just want to learn all the different facets for it.
No, I think that's really good because I took kind of what you said as like, okay, I was internalizing it. I was trying to learn the industry. I wanted to be doing this long term, but it's to eliminate an expense. It was both things. Like I wanted to learn all that stuff, but I also wanted to be self-sufficient. I think the self-sufficiency for me was number one. But because like you know, and we talked about, there's a lot of realtors that don't know investing, and it's like, you know, a lot of them will say, "Oh yeah, I can help you, you know, buy a duplex or buy a quadplex or whatever," but that's normally not the case. Or they will be able to submit an offer for you, but they don't know, and they don't know how to guide you. And I feel like for me and for a lot of guys that are listening and that want to start, you know, house hack number 1, year later, house hack number 2, like get into that groove, you know, buying a property a year. And if you're actually putting the time in to learn the industry, it's 100% worth it. But like you said, if you have no interest in learning the industry, I just feel like it kind of goes hand in hand. If you want to buy every year, maybe that's just my perspective, that I would assume that you want to learn the industry. But I guess for some people that might not be the same motivation. Yeah,
and the motivation, why are they getting it is critical.
Right.
And it's like any skill, right? You just have to put your 10,000 hours in. You got to learn it, and you either get really good at it, and I guarantee over time you'll figure out a way to save money. But I would argue all day long, if you had a realtor who understands it all, they're gonna find you some inefficiencies and get you some good deals over the long term.
Yeah. Awesome, man. This was a really, really awesome episode. We're super glad that you gave us some time. You know, what's this been, almost 2 hours?
Yeah, coming up. Yeah, it's been so much value you've given us. Just like, even for me personally, just some of the things that I had questions about and things I hadn't even thought about before. Just, you know, definitely opened my eyes up to some of these new things. So, Matt, really appreciate you coming on, and, you know, hopefully we can, you know, get more information from you in the future. But again, really appreciate it.
Yeah, happy to share, and you guys motivate me. You guys get me excited. You guys being authentic, keep doing what you're doing.
Thank you, brother.
Thank you.
All right, man. Peace.
Take it easy.